Welcome to Indianomics. The one sector that rallied last week in an otherwise ranged market were the banking stocks, after the Reserve Bank removed or proposed to remove a bunch of constraints and brought in more pro-market steps. The most important, according to me, banks can now fund corporates to do acquisitions. Second, the limit of 10,000 crore on total banking exposure to one group goes, that cap goes. Banks and their group companies can do overlapping businesses, which of course benefits a lot of people like HDB and, Canada Housing Finance. Risk weights, or the amount of capital that banks have to set aside for home loans and MSME loans, are likely to come down with the Basel III norms. And finally, very important, on the deposit side, premium to insured deposits won't be a flat rate. It will depend on how less or more risky a bank is perceived to be by investors. Now, to discuss how much banks and the economy will benefit, and also if the RBI has been too bold in removing some of the guardrails, I have with me two former RBI Deputy Governors, Mr. HR Khan and Mr. SS Mundra. And in a bit, we will be joined by Suresh Ganapathy is there with us, the Managing Director and Head of Financial Services Research at Macquarie Capital. Gentlemen, good morning and thank you very much indeed for your time. Mr. Mundra, this deposit insurance marketization has not been discussed enough. Last week, we all went to town with this acquisition financing and this 10,000 crore cap. But the SBI chairman, when he spoke to us, said he spent 5,400 crore rupees in FY25 on deposit insurance, and he expects it to come down. You think this is going to be a very big benefit for, SBI, BOB, HDFC, ICICI types?
Thank you, Latha. But I think, of course, this is a no-brainer. It's going to be an advantage. Those who are running their shop well, and when you do the risk assessment and risk level is found to be low, obviously, as it is proposed, the rate of premium would be low. So, it's going to be only one way only, that whosoever is working well is going to be beneficial.
But how much, sir? How much can it benefit? Any ideas?
Pardon?
How much can the benefit be in terms of lower costs?
So it depends on ultimately what kind of slabs RBI proposed to come out with. But it could be even, I would say to begin with, it could be even 1/4 of what you are paying today.
Oh my God. Okay.
It is quite substantial. Yeah, this is how it should be. Otherwise, it has no meaning.
No,
Having said that, Latha, let me quickly, it's a great package. There are long outstanding demands and long overdue rationalization which has happened in this. Only there are a couple of areas where I feel probably is a kind of leap of faith by RBI.
Mr. Mundra, I'll come to that in 1 minute. Let me just finish this deposit thing because it is under-discussed. And I will come to where you see the leap of faith, which is a little scary. Mr. Khan, do you think the Reserve Bank has put this leap of faith even on deposits? I mean, are we not, for instance, the trouble that RBL went when Vishwa Ahuja left, or Yes Bank, or even more recently, IndusInd? Already these banks, private sector banks, they don't have the, the sovereign guarantee which public sector banks are perceived to have. And over and above that, there have been one case or the other. Do you think the RBI is being too bold with respect to small private sector banks on this deposit issue?
No, just before I talk about deposit issue, let me just quickly add one introductory sentence to what you say, slew of measures taken by RBI for the banking sector, and you said about banking sector rally. I think if you see the last few months, it has been a phase of simplification, liberalization and rationalization.
Yes.
And the whole concept is what is being called as optimum regulation, with bias for liberalization for the banks and ease of doing business. So this is in line with all those overarching principles. Coming to deposit insurance, I fully endorse my former colleague and friend Mundraji about this is a long-standing thing. It has happened. It's a good thing. But knowing the maturity of Indian market, one has to be a little careful about how it is communicated. If it is not communicated properly, there is a risk of run on some of the banks. So we have to properly communicate that and do bit of customer education about it.
Yeah.
Otherwise, but there could be some problem down the line.
It's just about 3-4 years ago, because of LVB, because of Yes, because of RBL, even unrelated banks like IndusInd suffered because people were just moving out deposits. So I'm a little worried that this flat one has gone away. Suresh, your thoughts on whether you will up the ante in terms of margins and lower operating costs for banks because of the deposit insurance. As Mr. Mundra says, it can be 1/4 of 5,400 crore for RBI, for SBI. That's a big deal. I didn't expect it to be so much. And are there more credit opportunities because of, acquisition finance?
Look, I mean, this is, if I were to really look where my analysts at and look at the overall numbers, at an overall operating expense level as well as at the overall PAT level, I mean, even if it is a number as large as 1/4, which I doubt, but could be the case in certain entities, it doesn't move the profit parameters in a big way, Latha. I mean, right? So it is not that my earnings have to be changed about 10-15% on the back of this particular issue. There would be some 2-3% impact on earnings coming from a lower deposit cost. Just one point here that I would like to mention for the benefit of audience here is that the way the scheduled commercial banks in India have operated, never in the history, at least the time that I have tracked, a single depositor has lost money when it comes to scheduled commercial banks failing. Because at the end of the day, the RBI steps in, a forced merger takes place, and eventually the depositor gets back the entire money, right? So there is never a single rupee of deposit that is lost. It happens in cooperative banks, not in scheduled commercial banks. Okay. The premium pricing has to take that factor into account because depositors have never, ever lost money in case of scheduled commercial banks.
Okay. No, my only fear is that the Reserve Bank has made life difficult for itself. We know that in Yes Bank's case, in several other LVB case, they went and looked for the buyer. Correct. They made life more difficult for themselves, is what I thought, especially for small private sector banks. Mr. Mundra, your leap of faith, I want to come to that sentence. Where are you uncomfortable with the removal of constraints?
Yes, Latha. I was telling, of course, I said great package, over 22 measures, and some of them were really long overdue. Some of them really had become outdated. But there are a couple of areas where I feel it more like a leap of faith. Of course, RBI, I'm sure RBI must have done its best. But having said that, let me just say, one thing, it seems from the total package that a lot of faith, a lot of belief has been put into the market economic mechanism and the board oversight. Now, as we all know, there is a sizable section of industry whereby, not by any motive, but by their whole construct, by their design, and also the tenure of leadership. Both the things, board oversight as well as market discipline, may not be equally effective on them or equally applicable to them as it is on the other section of the society.
Okay.
In that situation, how much could be expected from this discipline, self-discipline to come is something I think maybe RBI will have to keep supervisory antenna very, very sharp.
Which specific rule? Which specific rule are you referring to?
Specific rule would be difficult because how do you distinguish within an industry? But probably the level of supervision, constant supervision, those are the kind of things. At least in initial years, it has to come into play. Okay. That is one area. Okay. And second area, when it comes to M&A financing, again, it was a long outstanding demand. Nothing wrong in that. It opens an avenue for the banks. I am a little more worried about the aftermath of such financing. Yeah. Because if I go back to my experience with infra financing, what typically happens, let me tell you, that generally these are some of the large players who would be playing a major role in assessment and deciding the finance which is to be done. Yeah. Then it gets distributed among the smaller players also.
That's right.
Who normally follow the assessment done by the large
bank.
Fine up to that point also. The point comes later on because these large players, they have two things. They have a better capability to absorb the losses if they come out of this kind of financing. Or second, which I have seen in most of the cases, I think they have seen the early signs and they have been able to exit from the exposure.
Yeah, that's
They have distribution and all that.
Yeah.
While the smaller players, they
Get stuck.
continue to hold it.
Yeah.
And it's a temptation because if you can't go and do a large scale lending and all that, and if you have liquidity and you have to beef up the balance sheet, it looks like a very, very convenient avenue.
No, that's
So great level of underwriting, but I think if it is not sharp enough, then it was an experience. We have seen it. It's not a.
I agree.
I'm little worried about it.
I agree, sir. And that's my question to Mr. Khan as well. Are we sowing the seeds for the next AQR, sir? I mean, now things are brilliant. Low leverage, banks, very low credit cost, ultra low. We haven't seen those numbers in our lifetime. I'm sure you will know, your memories stretch back. But, if you get into, at this point, over 10,000, okay, that 10,000 crore I thought could have become 20,000 crore or 25,000 crore. Do you want to remove the cap altogether? Are we inviting trouble? And also, that little bit of a leg up we thought bond markets are getting, that also goes. So are you happy with this 10,000 crore cap going?
Oh, Latha, I have a vested interest here. I was part of the committee which had recommended that part of the borrowings by the large corporates, they have to move to corporate debt market because the whole idea is that the banks are getting overexposed and they are not really, they will have asset liability mismatch, they will have a skill gap. So let it be market mechanism to a certain point. That was the whole idea. And it has run for a while, but there has not been really any assessment. Actually, it was brought down from 25,000 to 15,000 and 10,000. As you said, possibly we could have increased the threshold and seen how it is working. So that is one area one has to look at, because the rationale given is that individual bank level, there is a group exposure limit. So we need not so much worried about the system level exposure. But there could be some risk lying there. So one has to be very, very watchful. On the merger and acquisition finance, I think this is their demand for a quite long time. In fact, you should know that it is not totally no. In fact, there is some element of merger and acquisition finance exists now. For example, if you want to invest overseas, buy a company overseas, there is a finance available from bank. And if there is a joint venture partner in infra project to buy out his share also, acquisition finance is available. But what is being done is a broad sweep. But let us wait for the draft guidelines. I hope they will maintain certain minimum level of equity from the promoter, because let there be no gold plating happening. But on the point of, just quickly on the point of what my friend Mr. Mundra said on board oversight and supervisory intent, I think they are very, very important points. And if you are giving so much of relaxations in the board and corporate governance standards.
Mr. Khan, I'll come back with those details. We have to run into a commercial break. One word from you, Suresh Ganapathy. Do you think credit growth is going to sizably improve because acquisition finance has come in? I mean, banks don't know whom to lend to. There aren't even any takers. Will this open an avenue sooner rather than later?
Look, these things are good supply-side reforms in the longer run. In the near term, there is a significant demand issue, right? For example, a lot of these acquisition financing, Latha, in the private credit markets, if you look at it, happens at an IRR of 15, 16, 17%. Now, that's a portfolio that banks won't take necessarily, right? So you are looking at a reasonable chunk of acquisition credit which banks won't finance because it will not fit their risk appetite. So you have to look in that context. So while I'm not specifically put a particular number to this particular M&A related thing, but maybe perhaps a percentage point here or there could be an improvement in credit growth, but not more than that. Longer term, obviously, corporates are flush with liquidity, there is excess equity, capital markets are buoyant. So, and even ECB rules, for all that ECB rules have been relaxed. So why not? Corporates can move towards ECBs rather than relying on some of these markets.
Only it is coming at a time when the currency is on a slippery slope. But I guess once it stabilizes, that is going to be a very big source of financing. Quick break. We have lots more questions for our guests. Bazaar viewers, you will be watching Chartbusters. You'll get to watch the entire argument and show after market hours.